Should you save, invest, or even pay off your mortgage with your hard-earned money right now? And that's the big question for many people, and it's become even more complicated now that we're seeing interest rates here in the UK at levels not seen for 15 years. Let's break down the options, talk things through, and try and work out the pros and cons of each before making our final decision. And spoiler alert, I don't think it's as obvious or as simple as you might think. Okay, so look, we're all here to try and work out where's best to put our money because all we want to make sure is that we make the most of it and get the best returns. Now, since the global financial crash, with interest rates being super low, the answer's almost always been that you need to invest your money because rates for savers has been terrible. Money was pretty much free to borrow, so people have been ploughing it into the stock market, the property market, and more recently we had all the madness around meme stocks, crypto, and NFTs. Yes, simple photos of monkeys managed to trick our simple ape brains into believing that there was value there. And let's not get started on the even sillier ones. Pet rocks, anyone? Anyway, where were we? Let's address savings first. It's probably the simplest idea to wrap our heads around, and it's one that we all get told to do. Savers in the UK have had it pretty rough for a long time, with interest rates on cash either being non-existent or just very low. Here's how the last couple of years have looked when we compare what savers have been offered, both in instant savings accounts and monthly savers accounts. Now see how the rates offered have been increasing as the base rate set by the Bank of England, that purple line here, has been increasing more than 13 times in a row. When rates were low, you were lucky to get about 1.5% a year on interest on flexible accounts, and about 2.5% per year for other ones. Now right now, you'll see that things are getting a little bit better, but let's be honest, isn't it funny how rates for savers takes a lot longer to move when compared to how fast mortgage rates go up? Strange that. Looking at some of the latest deals collected by Money Saving Expert, you can expect to get around 4% a year on your money in a flexible account that lets you move things in and out. Or if you can fix things for a year or more, you're now almost able to get close to 6%, with rates around the 5.8% mark. You can always lock your money up for longer, but looking at the 3 and 5 year terms, there doesn't seem to be much incentive, to be honest. Still though, 5.8% a year guaranteed interest sounds pretty good, right? So if you manage to put away £1,000, you end up with £1,058 after a year. So better than nothing, right? But as nice as that might sound, we have to remind ourselves of one of the biggest issues that affects all of these choices and has the biggest impact. And that is inflation. Funny enough, I did a similar video about 6 months ago as we started the year, and a lot of the points still stand. I called inflation the elephant in the room because no matter what return you get from savings, investments, or anything else, it's totally irrelevant if you don't factor inflation into the mix. Here's a chart showing us that over the last 10 years, savers have lost money in real terms. So that's what you would get when you put your actual return and then minus inflation. In fact, only 2 years out of the last 10 have savers actually made any real money, even if that amount of money looks bigger in your account. Now, as you can see, the worst year was 2022. But then this was also bad for lots of other kinds of investments too, which we'll talk about in a moment. So look, savings are great for being simple, risk-free and easy to access in an emergency. And let's not forget that we all have a personal savings allowance up to any interest we make up to £1,000 for basic rate taxpayers, which does drop down if you find yourself earning a bit more. Also, if you want to protect yourselves fully from the taxman, then don't forget to use your cash ISA, where you can then use your full £20,000 a year allowance if you really want to. But do remember that this allowance is spread over all the different kinds of ISA accounts, including stocks and shares. And on that topic of stocks and shares, why don't we talk about option number 2, investing our money into the stock market. Now, we're moving up the risk scale from almost no risk, we should expect to start to see some bigger returns. However, investing in the stock market, as exciting as it sounds, isn't always smooth sailing. Now, you often hear lots of numbers thrown around when it comes to investing, that the stock market delivers on average 9 to 10% a year for investors. But then you also remember that just last year, the S&P 500 was down almost 20%, having its worst year since the global financial crash. The only way investing works then is by focusing on the long term, which is always easier said than done. Now, to work out if investing is a good way to spend your money, let's zoom out and have a look at the data. Now, lucky for you, I've got 200 years worth, and if that isn't worth a gentle touch of the like button and subscribe, then I don't really know what is. Anyway, here on screen now is 2 centuries worth of data looking at the real returns of the stock market compared to bonds, cash, and commodities. Remember, these are real returns, so this is taking inflation into account, which is really important as we've just found out. So picking out a few key numbers then, over the whole 200 years, this row tells us something really important. The stock market delivered on average 6.66%, followed then by bonds and cash. Now this might not sound like a huge amount, but let me just run an example showing how this all adds up over time. So if you invest £1,000 for 200 years and you get a return of 6.66%, you end up with quite a bit of money. In fact, this number is so silly I had to recheck this. That £1,000 becomes £587,230,793. Now, if only my great-grandparents could have done this for me, I'd have been a very rich man. Even taking into account much shorter timescales, which is probably a lot more reasonable for a lifetime investing, just going back to that table, even if we take the last 25 years or even less, we get even better returns. And just think, during that time we've had the dot-com bubble, the great financial crisis, and the madness of just the last few years. Just to be fair though, bonds haven't done that bad, you'd still have made some money, but you would have missed out on a huge amount of gains. However, while this all sounds good and you're thinking that investing is a no-brainer, unlike savings that guarantee a return every year, we have no idea what the future holds. There's been plenty of times when the stock market didn't return a single penny across decades, and the reality of investing is much more of a roller coaster. Here's the last 60 years of returns each year showing whether the stock market went up or down that year. And as you can see, although mostly it's been positive, we almost never see that 9 to 10% a year in any given year. We're either flying high or we're crashing down. Now, what comes next? Well, that's anyone's guess. Just as I mentioned earlier though, investing only works with that long-term mindset, and the longer you invest for, the better your chances are of making money. Bear in mind here, I'm not talking about individual companies here, this is just the stock market as a whole. Most companies eventually go bust, and only a small number of companies make up the whole returns of the entire stock market. So just bear that in mind before you go all into investing. Now, if you're going to do it, I've got plenty of videos on my channel to help you, and I strongly believe that most people should stick to using low-cost index funds to take advantage of the market and end up beating most people. Also, sticking with the investing topic, let's think carefully here too. If you invest using a stocks and shares ISA here in the UK, you can grow your wealth completely tax-free, so that's a huge benefit. And also remember that investments are really liquid as an asset. All that means is that they can be sold super quickly and turned into cash if you ever need them. Property and other kinds of fixed assets take a while to sell, so while they might make your net worth look impressive on paper, in liquid terms they might not be so useful if for whatever reason you need to get hold of some money. Oh, and one final thing on investments, there's no limit to what they can grow to, which is nice. Now, putting saving and investing to one side, this next subject on whether or not you should pay off your mortgage early is probably one of the most interesting ones. You see, with really low interest rates, when people had mortgages with less than 2% in interest payments, it would make almost no sense at all to pay it off earlier, because there would usually be loads of better things that you could invest in that would give you a better return. By paying off your mortgage early, we guarantee to save the money on that interest, so when it's low, it's really not much of a consideration, unless you really just want to be completely debt-free for some other reason. Now here's where things get interesting. With these 13 consecutive interest rate rises coming from the Bank of England, this has caused new mortgage rates to hit highs that haven't been seen for years. As I showed in my last video talking about the current mortgage crisis, moving from a low interest rate to one around 5.5%, which is apparently the average rate now for a 2-year fixed mortgage deal, a typical household is probably going to end up paying around £300 a month extra on their mortgage. For a lot of people, there goes all of your spare cash already, but let's just say if you did have the luxury of having more money, then what do you do? Let me just run a quick example using a mortgage repayment calculator from Money Saving Expert's website. I'll say that you have 170k on the mortgage, 20 years left in total, and we'll say that the interest rate we've just moved to is 5.5%. Now, if you're able to overpay by £200 a month, here's what you end up with. You'll save $28,620 just on the interest alone. But more importantly, you'll also shave off 4 years and 7 months from the mortgage, leaving you all of your payments after that point for you. Sounds good, who wouldn't want that? The only thing we have to ask ourselves is, what's the alternative? Well, investing or saving, as we've just seen, is a pretty good alternative. From an investing standpoint, if we did get the long-term average of the stock market, even after inflation had been taken account, so that's say 6.6%, then using that same £200 a month, we would have ended up with £64,300. That would end up being a net gain of just over £6,000 because the mortgage balance left would be £58,000. So in theory, you could have paid off the mortgage and then had some money to spare. Sounds straightforward, but let's be honest here, there's a lot more to think about here. There's a lot of variables, and firstly, you could say that house prices will probably go up and you're using leverage, aka debt. So if anything, once your mortgage is paid off, you should end up with a pretty big asset even if you don't repay early. And just as an example, a 250k house today, if the value goes up by just 4% a year for the next 20 years, becomes a property worth £555,000. Now bear in mind though that this is before taking into account any kind of inflation. If we take this into account, apparently the long-term average increase in house prices from 1975 until the present day is only actually 2.4% a year. Also, when making a decision like repaying a mortgage early, we have no idea when the interest rates are going to be in the next few years once we get through the current rates. There might be forecasts that we go down in 2024 and beyond, but we might never get down to the lows of the last decade ever again. In fact, this is probably the new normal and much more in line with the long-term average in the UK. Now, another thing you have to consider is that although paying off the mortgage will feel pretty good, once you have that asset paid off, do remember that a house is not a liquid asset. And especially if you're living in it, ultimately you're going to need to find somewhere else to live or rent before you can get hold of that money. Now, for most people, their house will be a really nice asset on paper and a nice place to live, but just remember that it's not money that you can easily access just like you could in a savings account or in the stock market. Let's also always remember that your house needs plenty of upkeep as well, with maintenance, council taxes and other costs just to keep it ticking over, unlike savings and investments. Now, with all that said, the biggest point that I quickly just skipped over is that feel-good factor. Having your mortgage paid off, which is most people's largest monthly cost, will feel amazing. And this then frees up a huge amount of money for you then to invest if you like, or spend on other fun life experiences, maybe giving you even the choice to give up work early or just do less of it. Now, one thing we haven't spent enough time on during the whole video is really the question about risk, but more importantly, your own personal level of risk that you're happy to take. So, although the numbers tell us that the stock market delivers the best long-term returns from centuries worth of data, that's no good for telling us how we'd feel if the market doesn't go anywhere for the next 10 or 20 years. More risk does tend to offer greater rewards, but then there is a downside as well. Saving or paying off your mortgage is a guaranteed return because you know exactly what you're going to get by the end of it, whereas the stock market is the odd one out here with returns that could be all over the place. Now, 2023 started really well for the stock market, and you could be feeling a bit left out if you're trying to pay off your mortgage, but then we have no idea how the year's going to end up. This heat map from BlackRock is always quite a useful thing to show you. Now, each column represents a year going back to 2014, and each coloured square is an asset type like stocks, bonds, property REITs, and other things like commodities. All of these assets can do really well in any given year, as well as falling in the other direction too. Now, just take 2022 as a really nice example. The best performing asset class was commodities, followed by cash, and then less than a year later, here in 2023 so far, commodities are now near the bottom and stocks are on the top. It's only once you think long term where you can start to see some clear results, and this column on the right gives us a full picture showing US stocks leading the way with over 11% a year returns on average over this period in history. So is there really an answer to this? Well, it really all depends on what you think based on how much risk you want to take and how much certainty you like in your life. I think it's worth saying that if you even have a choice to pay off your mortgage or invest your money, you're already in a very comfortable position compared to many people. The current interest rate rises will crush a lot of households who aren't going to be able to find that extra £200 or £300 a month when they have to remortgage over the next year or so. If you can afford to pay the additional money and pay more on top of that to repay your mortgage, I personally count yourself very lucky. And just make a decision that's right for you. Anyway, I hope you've enjoyed and found that useful. I'll let the magic of YouTube decide on the next video for you, but please do leave a like on the way out, subscribe for many more, and as always, happy investing.